Guys, and welcome to another video. We are going to be talking about what is free cash flow. So let's get right to it. So what are we going to cover? We're going to cover what exactly is cash flow from a very layman perspective. I'm going to take some simple examples so that you understand this. Where does this free cash flow concept finally get used? What's the formula, how to derive it, and finally a simple case study so that you can practice it out. The link of the template is in the description, so do make sure to download that before you start with the video. So free cash flow, in order to understand free cash flow, you need to understand on one angle you have business and on the other angle you have stakeholders, right? So stakeholders can be many. It does not necessarily mean just the owners of the business. It can also be suppliers of the business. It can also be the bank, right? And it also can include equity shareholders, right? So let's understand how does cash finally flow in terms of a business. Forget about any income statement, balance sheet or cash flow. Just think logically. In a business, once you're running businesses, your first priority is to pay the suppliers because you won't be able to run the business unless and until you pay for the raw materials that you've purchased, right? So the first cash goes out is to the suppliers. Then, of course, the next priority is the bank because the bank needs their interest, right? So once the suppliers are paid, which we also call it as working capital, then the next is to pay the interest and the repayment, right? And after that, finally, we'll be doing some investments in the business, right? Because you don't want to really put the money in the owner's pocket before you have actually used some of the money to invest so that you can grow the business, right? So that's how the money finally flows. And at the end, it reaches to the owners. So there is some cash at the end, which is free. So that's the concept, right? Now let's move a little further, right? So in the process of actually finding out what is the cash which is free, there are some adjustments which you have to do, right? The reason is the income statement which we refer to is finally on accrual. It's not on cash. That means there might be situations where we are selling a product, but probably the cash has not come, right? So there are some adjustments. For example, it might be depreciation, right? It might be, let's say, accounts receivable, in which I'm selling a product on credit. The amount might come later. So that's basically the logic of adjustments, right? Now, how do you identify non-cash items? So very simple. If I try to categorize these adjustments in four simple sections, one would be revenue. So there might be some adjustments for the revenue because you might be doing sales and credit. Second is your depreciation, which is related to EBITDA, right? Your fixed assets. Your cost of goods sold, because also your suppliers might be paid in credit. That's the reason why you will probably have good supplier relationship. Then probably the supplier is giving you some credit of 30-40 days to pay them, right? So accounts payable is one of the account in the balance sheet which needs to be adjusted for, right? And finally, interest can also be accrual, because if you are paying probably interest quarterly but your calculation might be monthly, so in that case, accounts payable also comes into picture. So there are four basic categories of adjustments. That's all, right? Now, what is the adjustment technique, right? Very simple, straightforward. You don't have to ever remember this again. If it's an asset, all you do is you subtract the previous year minus this year's value from the balance sheet. For example, if you're talking about accounts receivable, so accounts receivable value last year minus accounts receivable value this year will give you the change or the adjustment required to calculate the free cash flow, right? Second, if it's a liability account, then you do the opposite. This year's value minus last year's value. Example, simple, like accounts payable. So this year's accounts payable value minus the previous year's value, right? So that will give you the required adjustments in order to make sure your cost of goods sold and your revenue or your depreciation or your fixed assets or your debt gets adjusted to actually find the cash value, right? Remember, all we are trying to do is trying to find the actual cash paid. That's all. Do not complicate yourself by trying to memorize the formula, right? Now, let's try to understand that what are the different kinds of stakeholders in the company. If we're talking about equity shareholders, then let's look at the flow of the business, right? So you've got net income plus depreciation, which is available for the equity shareholders, right? Because net income has paid all of the expenses before this, right? Interest, your suppliers, everything has been paid. And now, but depreciation is a non-cash charge. Remember the adjustment that we had to do? So we added back the depreciation, right? Because it's a non-cash charge. Second, the working capital change. Now this is the place where I was talking about the change in accounts receivable, the change in accounts payable, right? Change in inventory. All these are finally accrual accounts. So if you just find the change, then your working capital, your net income will automatically get adjusted for the cash, right? Second is plus or minus debt, change in debt. For example, it might so happen that you've repaid debt. So that has to be reflected in the cash flow calculation. And after that, you reduce any capex investments or fixed assets investment that you have done, right? So that's basically the change in fixed assets. And finally, what is left is nothing but free cash flow to equity. That means that's the free cash available for the equity shareholders, right? Now, there can be situations where we don't want to calculate for only equity shareholders, but we might want to consider that the stakeholders include the bank and the equity shareholders. In that case, you will not take net income because net income has reduced the interest. So maybe the line item that you want to skip to is EBIT because that includes interest. So I take EBIT post-tax and do the same adjustment of adding the depreciation. Do the working capital change just like in this previous formula. Do the fixed capital investment just like the previous formula. But we do not do change in debt. The reason is, in case of firm, we're talking about the bank and the equity shareholders as the target for which we're trying to calculate this free cash flow, right? So you will not repay the amount for whom you're trying to calculate the free cash flow. And that's the reason why you do not reduce the debt, right? So that gives you free cash flow to firm. Now, where is the uses of free cash flow? See, it's used everywhere. For example, you cannot do valuation, DCF valuation of a company unless and until you calculate free cash flow. Second, credit rating. See, because at the end of the day, your income statement is based on accrual. So I cannot give you a credit rating on how good you are or how much capability you have to repay the debt unless and until I know how much free cash flow you generate, right? Second is it might also get used for feasibility calculations like IRR and NPV, which also requires FCFF and FCP calculation. Now let's move into the template and try to calculate this manually and see how it actually works. Let's look at the template out here. You might want to download this template before you actually practice this. So if you have not downloaded, pause the video and download this. And now let's apply the same logic, right? So let's say we're talking about equity shareholders, right? So if you're talking about equity shareholders, then we mean to say that we want to refer to profit and loss or net income, right? Because profit and loss has already reduced the interest. Everything has been paid, even the tax has been paid, right? Now, dividends you will not reduce because dividend belongs to equity shareholders, right? So let's start with net income out here. So I've written net income and I'll just zoom in a little bit so that you can see this a little better. So there you go. So net income, I linked the net income, great. Now we want to add the non-cash charge, which is the depreciation, right? So we can just go to the income statement and see that the depreciation, which is reduced, which is non-cash expense, we'll add it back. Right, there you go. Now you want to find the changes in working capital, right? So there you go, working capital accounts. Remember, it is inventory, it is accounts receivable, accounts payable. So remember the trick I told you. In case of it's an asset account, all you need to do is last year minus this year. Now, if you see this balance sheet, we really don't have a last year, so we can consider that as zero, right? So since we're talking about inventory, we'll do 0, which is last year, minus whatever the inventory amount is, about 46 to 50, right? So negative, there you go. So that gives us the adjustment for the changes in working capital for inventory. Now let's talk about accounts receivable. Similar, asset last year minus accounts receivable this year. And accounts payable is a liability account. So you want to do this year, which is, if you see here, 25,000 minus 0. So that's my working capital change majorly, right? Now let me just add this up. So the total changes in working capital comes out to be 23,125. You might want to total it out, or you can skip totaling and just say CFO. Or if you want to skip totaling, you can skip the total and just try to calculate capex out here, right? So capex is 0, which is asset account, so 0 minus. Now you want to be careful out here. You want to look at the balance sheet value if it actually includes the net value or the gross value. Because if you do change in equipment for the net value has reduced the depreciation. So that won't make sense. So if you see out here, 9583 has reduced the depreciation, right? If you look at the linking it here, right? But in reality, the actual investment which is done is 10,000. So I'm going to manually put it out here. In real models, it's very easy because everything is linked, but this is just an example. So it might, we're doing the hard coding for this case, right? Now we do change in debt, right? Change in debt. And again, similar logic this year, which is 20,000 minus 0. There you go. And that becomes my free cash flow to equity. And in simple terms, all we're trying to say is that this is the amount of money which is left for the equity share, which turns out to be negative. So that means we have a free cash flow to equity as negative, right? Now let's try to talk about if we are not talking about equity shareholder, but we are talking about firm, right? So in case of firm, remember I told you we can start with EBIT, right? So let's see. Now if in case out here there's no EBIT, so we can derive that, very simple. What we'll do is, but I'm still gonna label this here, right? So EBIT, we will derive the EBIT, which is nothing but net income, right? Plus the interest expense. So I'm just going to do a minus out here. So that gives me the EBIT post-tax, right? In this calculation, of course, we have not considered tax, but nevertheless, we will do this 30%, right? And then we add the depreciation, similar, nothing much changes out here. So it's just going to link out it from here from the left hand side. And the working capital is same. So I'm just going to copy this, right? Nothing changes out here. So I'm just going to directly copy this. In fact, all of these are going to be same, right? Nothing really is different for the firm. So there you go, that's capex. But change in debt we don't do. Remember why? Because firm includes the debt holders as well, right? So you don't want to calculate for the ones whom you calculating the free cash for, right? So I'm gonna just sum it up from the beginning, same calculation, and you will see that the free cash flow to firm is 32,095, right? Now you might want to just look at the calculation and just try to get a brief idea of what exactly is happening, right? Now you want to just notice out here, you might say that, okay, free cash flow to firm is, higher negative and free cash flow to equity is less negative. The reason is the change in debt, because change in debt is positive out here, right? That's the reason why your free cash flow to equity is higher than free cash flow to firm. So that's what is free cash flow to equity and free cash flow to firm. Majorly important for interviews, also important for valuation, for calculating IRR, NPV, and tons of things. Free cash flow is something that you have to know, and I hope this video makes sense. I'll see you in another video.